that. All right, so what are we talking about today? We're talking about Profit First. It's this book that if you learn one thing, it's basically take your revenue and pay yourself before you do anything else. That's the whole idea. I mean, really, there's an entire book dedicated to paying yourself first. It's this old idea that we've heard, particularly in investment circles. The Richest Man in Babylon, I think it's an old book about investment. And the whole idea is you get money and you pay yourself, and then you figure out what to do with the rest of your money. And you say, this is how much I need to go about my business, to live my life. And so that's just, the first principle anybody talks to you about investing. But they've taken this, Mike Michalowicz, I think I'm saying his name right, has taken this to a business perspective. But he has taken it and he's really thought about this in a lot more detail. It's the same principle. Again, the classic idea for accounting is we sell things, we have expenses, and whatever's left over are our profits. But he says, no, let's try this the opposite way. Let's go sales, take out our profits. What is the money that we need for ourselves to make ourselves happy as business owners, as whatever? We set that aside, and then whatever's left over is the expenses. So focusing on your profits. Profits are first. It's in the book name. It's simple. Hypothetically, I could stop right here and say, there's nothing else to talk about. Let's go to the chat. There's a lot of interesting things he talks about in this book. I do recommend it. Just as you know, I get ideas from different people. I got this from an accountant who says she's really interested in it, and there is a whole side market for accountants and banks who get into the Profit First network, and you can sign up to work with a Profit First professional, and it's kind of a little annoying at times in here in the book, but I guess it's a business. You sign up for the Profit First perspectives, and you can get hooked up with an accountant. It's obviously not so annoying because I actually did sign up because I'm in the market for a new accountant. And so I said, well, let's see what happens if I put my name down in this little web form and see what happens. So why do people read this book? I will say a lot of people start this book or get this book when they're in trouble. They've started a business, they've done their work to build it up, they make all this money, and then they find themselves in this survival trap. Their expenses get out of hand frequently. And I think I'm going to honestly say, knowing most of you, this is probably not necessarily relevant, because I feel like knowing all of the group, you guys are all pretty responsible. That being said, I'm very cognizant of this Profit First perspective right now because my revenues are changing very quickly, and so are my expenses. And I have a lot of concern that I'm going to have a whole lot more revenue and I'm going to just get free and easy with my expenses, and my expenses are going to start to exceed my profits. We've all had clients who say, oh my God, I just won this $10 million grant, right? And they look at it and they go, we have all this money, and they're just celebrating, but then they realize, hey, $10 million doesn't go as far as you think. We've all had that experience. I have a client right now who's in their 5th year of a $1.5 million project. And, it was just like, oh my God, I've never seen so much money at the beginning, but now they're very, very, very careful with their money. And it's really interesting to see how that's changed. So I'm very aware of that from my own perspective because I have a lot of changes. And so that's why I wanted to make sure I read this book. And I think it's definitely relevant for us mid-career people, but it's actually even more relevant for our early career people because you set up a system early so that you're thinking about this ahead of time, so that you're making sure that you are in fact setting this business up so that it's profitable for you, so that it's doing the things that you want to as the owner operator. So people get into the survival trap where they're not seeing a profit. Their business is no longer working for them. They're really just working for their business. This happens a lot, particularly when we take on employees. I have a fantastic employee. You guys have heard me talk about Tom. I wish I'd hired him, 5 years earlier if I had the ability to do it. We have a great relationship. I worry about bringing on more staff and bringing on staff that are not that are going to be expensive and won't fit my bottom line. the other thing with this, with this survival trap perspective, people get lines of credit. I have a line of credit for about $30,000 just so I can cover bills as things come and go. But people get to the point where they max out their credit, and they could hypothetically, it's never happened to me, I've never heard of it happening, but I read about it in the book, where your credit is called by the bank, and you have to figure out how to pay it all back within 60 days or something like that. And people oftentimes work their way out of their crisis. So, but at a certain point, working harder is no longer working, meaning you're no longer making the money back that you need to when you find yourself in that situation where your expenses are exceeding your revenues. So here's a picture that he put in his book. Here's figure 1. Ways that people get out of a crisis are all those smaller arrows, but the point A is pointing to point B, the vision, and that's kind of the idea of moving towards this profit first perspective. One of the interesting things he does, and I'm going to go through this exercise with you guys, is this instant assessment. The instant assessment is taking, I want you to pay attention to just the empty left column, actual. The other stuff I'm going to explain on another page. But this is his figure 2. I took it directly from his PDF. And I'm going to explain these things, and then I'm going to go through the exercise in just a second. But the instant assessment at the top line revenue is the amount of revenue you bring in. It's your gross revenue. Now, oftentimes, the revenue that we bring in isn't really our revenue. We're kind of a holding place, particularly if we have subcontractors or it's just expenses that are going straight out the door. So when I don't have any control group members right now, but I would bring in money and it would just go directly to the control group. I would just administer that. So that would be a subtraction in the second row. So that gets you down to your real revenue. So your actual minus your holding, your material and subs is your real revenue. And that's the big calculation that we're thinking about here. So what you'd do is you'd subtract profit, the amount that you've received in pay through distributions or salary, and the amount of tax. And then the reality is everything that's left over that were expenses, those were your operating expenses. So you don't have to do all the work on, well, I spent it on food, I spent it on equipment, I spent it on my lawyer. Basically, at the end of the day, that's how much you spent in operating expenses. If you didn't take it as profit, as pay, or pay it in tax, it may be sitting somewhere. If it's sitting somewhere as profit, it should be in the profit area. But if it was spent, then it would be in the operating expenses. And so what this does is you start to look at this and then you compare it to, that's where we're paying attention. You compare it to their allocation percentages. And if you are, for most of us, in the $0 to $250,000 range, these are those target allocation percentages. And the big key here is to look at 30%, because in his mind, in his book, we can argue about it all day long. I'm sure we very well may, that of the money that you bring in, your real revenue, only 30% of it should be going to operating expenses. And yes, that includes your employees. It does not include you as an employee, though. So that's a key point here. It includes your employees. So 30%. Now, you may, in many ways, once you get into several employees, you might find yourself over here in the 250,000 to 500,000. You're probably not getting many employees until you're in column B or perhaps column C. But all right, let's do an exercise because I built this out last night. I think it's kind of fun. So, put you over here. I'm going to move. So I'm seeing. Can somebody type in the comment box that you can see my Excel spreadsheet? Oh, this is the wrong one. I'm going to open up a different one. Sorry, guys. That's totally. I have built out a totally different one. I'm sorry. I'm going to get to it here. All right, there it is. Okay, here. there we go. So in this situation, I'm going to delete, I was playing with it this morning. This is our overspender situation. So let's pretend, let me check to see that I can see that you guys commented in the chat box. Where do you get 15% tax? Oh, Susan, definitely I'm going to talk about that. That is a big, that number is something we definitely need to think about. Can you guys confirm that you can see my Excel spreadsheet? Somebody type in the chat box that you see it. If not, I'll figure it out. Confirm. Thanks, Chelsea. All right, so here's the idea. Let's just say we're a typical, probably somebody in their 6th or 7th year of working. They're a one-person shop. They may or may not have, in this situation, they don't have any subcontractors just for ease, and they bring in about $125,000 in their revenue. So they have $0 in materials and subs. That in this situation, they realized $1,500 in profit. Their owners pay. This is, they took $42,000 in annual salary, and they paid $13,050 in taxes. Their operating expenses, because that money didn't go to those other places, that it was, and it doesn't still exist in your checking account or in some sort of an account. It was spent. It's gone. You spent $68,450 in other business expenses. We can go into the details of it. It's not worth it, because at the end of the day, that money's no longer there, and you don't have it. You did it personally, but it's gone. And that's kind of the key point to all of this. You had $125,000, and you only took effectively $43,500 for this in this situation. And so, according to this calculation, you spent $31,000 more than you needed to. And this is where people find and sit down and realize, hey, I'm in trouble. I'm spending way too much in expenses. And I can be honest, I put myself out of balance. I went back and I looked at 16, 17, and 18. I was actually doing really good within these calculations. I did take on an employee last year, and I knew I was going to be out of balance, and I certainly showed it, because these are not my numbers, but they're not too far off. I was definitely in a overextended version of operating expenses. I see the 15% tax question. So what's 15%? I think this needs some judging, some adjusting, but so typically if you're going to take a distribution, you're going to take 30% tax. I'm going to take 25% and set it aside for the government, and 5% for the state of Illinois. But that's not how much I'm taking in real revenue. Real revenue, you're talking about after your operating expenses. So that's what they're thinking about there. So you're going to, the amount of money that you're taking for tax is just for what you're going to be compensating yourself, either through owner's pay or profit. Now, another thing to point out here is that 15% does, in fact, also cover owner's pay. So when you do this calculation, I had to go look at my pay, because that was a wholly different account. I don't think about it that much. I think about it once a month, but I think about it now in relationship to my my employee. So let's look at an ideal example. So I will delete this stuff. I'm supposed to do that ahead of time. Anyway, so same kind of a scenario. We have $125,000. We're working with a subcontractor for $5,000. This person realized $15,000 in profit, and they paid themselves $50,000. So a lot of us, I think, can go out into the real world and we can make a lot more than $50,000 a year. I keep my salary low, just as a quick side note, because then I don't pay as much overall tax, because I pay more tax in employer taxes and employee taxes than I do when I realize it as a profit, as a owner distribution. Just quick side note. And in this situation, this person paid $19,500 in taxes. Their operating expenses were about $35,000. I think this was similar to my 2018. My 2018 number, my top line revenue was more. But in this situation, you could hypothetically increase your operating expenses by $500. you probably overpaid in tax, and you probably see, according to this calculation, you might see a $1,500 taxes that you don't have to pay, or you have it set aside. You could hypothetically increase your owner's pay, and you took a nice profit here. So between these two, they probably even themselves out. So you did a pretty decent job in this situation. So what this does for a lot of people is it sets them down, particularly if you're out of balance and you're putting too much money into operating expenses. It starts to give you an idea of what you should be doing. So I'm going to go back to that Excel spreadsheet. To the PowerPoint. So in this PowerPoint situation, we're looking at column A, the 0 to 250,000, which I think is going to cover probably 80 to 90% of our consultants and independent consultant tech. But certainly look at these other allocation percentages, because your profit can go up, your owner's pay is going to go down as you go up to higher and higher numbers. Hypothetically, when you're at $10 to $50 million, you're no longer getting owner's pay, you're just taking profit. Hey, I want to take 20% of $10 million annually. That would be fantastic. Let's do that. And your tax stays the same across all the different levels, and your profit is changing. Your profit's going up and your owner's pay is going down, like I was saying, as you're going up in these numbers. Let's see here. Here's the next big idea he has in here. So the big idea first is profit first. Second, here's a way to think to see if you're out of balance. The third big idea I think he has is that you set up lots of different checking accounts and savings accounts. If you go back in time, we all have had a grandmother or an aunt or somebody who would talk about, back in my day, I would get my money, I would get my $1,000 for the month or whatever, and I would take it and I would have 5 envelopes, and I'd put some of it for rent in one envelope, and I'd put some of it for what we needed for food for the month, and they'd have the 5 envelopes, and never would you cross between the different envelopes. Whatever you had for food, that's what you took, and that's what you had at the grocery store. If you have to eat macaroni and cheese each day, that's what you had to do. So maybe you had more that month, and you could spend more on it. Rent was going to be $250 regardless, since the $250 went into that envelope. This is the same idea. In your bank one, you have 5 checking accounts. Income, everything comes in there, and then it quickly gets distributed out to the other accounts. Profit, you take in this situation, you would have 5% profit. So if you brought in $100, $5 is going to go into profit. Your owner's compensation, key point here is your owner's compensation is separate from your operating expenses or your OPEX. Owner's compensation, that's where you're paying your salary. I have a little bit of problems with this because I don't know if I want to have different checking accounts for me and my employees' salaries, but this is the way he talked about it. And then you're immediately setting money aside in your tax checking account. Now, once you've done this, you really aren't letting your profit and your tax sit for very long. In this situation, in his suggestion, I kind of like this actually. He sets up a savings account in a wholly different bank, one that doesn't give you all the advantages and all the perks and everything of your checking accounts. That's kind of the point. Once you take this money out of your main operating accounts, you want to make it difficult to get at it because you want to remove the temptation that you're going to touch your profit and your taxes, because hypothetically they should be set aside for your quarterly estimated taxes, and then hypothetically you're not touching your profit until maybe the end of the year, or maybe you're going to set it up so that you can buy a big house, a new building, or some sort of equipment, or you're just going to take it so you can go on a fantastic vacation in Tahiti. Whatever. The point is you're taking that money, you're setting it aside, and you're not touching it. Very, very infrequently are you touching it. And so those are actually savings accounts in Bank 2. Bank 2 is you don't want all those advantages. You don't want to be able to just spend freely off those accounts, make it very complicated for you to do it. So those are some of the big idea. Oh, Susan, that's how her dad budgeted. I love that. All right, so there's 4 core principles to this. And it's actually, all of this comes straight out of like the dieting ideas, right? use small plates. We do this in my house. My wife started doing this years ago. We have small plates, so when we sit down to dinner, we don't fill our plates up and eat all the food. The idea with this is you're using small plates, plural. You're using several different checking accounts where you're putting the money that you need for your operating expenses in one. You have 30% to use for your operating expenses if you choose to go with that calculation. I think it's an interesting one. You set that all in one checking account and you spend out of that. If you run out of money, then you need to find a way to cut back on your expenses because you're spending too much. All right? Serve sequentially. So you're taking one thing at a time. In the dieting ideas, you eat your vegetables first. In this, you are taking your profit first. You're removing temptation by putting the money that you want to set aside, that you're not going to use very often, into in savings accounts and a whole other bank that's very difficult to get to. It's kind of like our savings for our retirements. Hypothetically, I hope you guys are all saving for retirement right now, but you're putting your money away, and it's complicated to get it out. You have to pay a penalty to the federal government. Who wants to do that? So it's the same idea. Remove the temptation to use your profit and your tax money. Put that away, don't spend it. And then enforce a rhythm. And you're doing this on a regular basis. They talk about good accounting principles, good accounting practice is to pay your bills on the 10th and the 25th. I guess that comes from some accountant that worked with Mike Michalowicz. But the idea here is you are doing this regularly. And actually, one thing he doesn't put in his core principle is at some point you make it kind of a game. You learn to enjoy it. Because at some point, maybe you put yourself on track, but it's like a diet and the yo-yo diet. If you lose a lot of weight, at some point you stop trying, you go, oh, I lost all this weight, why do I need to keep exercising, and why do I have to keep eating carrots? I'm so tired of carrots. Well, at a certain point, if you're going to do this and you're going to be successful and you're going to have a lot of extra profit and you're going to enjoy your business, you need to learn to run your business in a way that's fun. I mean, you need to enjoy the ideas of setting money aside. And if you're doing this, there is a bit of a self-reinforcement to it, at least hypothetically. I haven't run my business like this, but I can say I got a check in the mail yesterday. I deposited it. It was for $3,950, and I took $395. It was 10%. I put it aside into a wholly different account that I know I won't touch. And it was kind of an interesting perspective. Because I knew I could get away with not using that $395, and maybe I'll set it aside and we'll see what happens. I'll give you guys an update on that. So I like to give you guys my 5.5 ideas that I get out of this that I think are relevant to us. This, as I've said before, is a kind of an idea that Jeff Gitomer uses in his little black book of Selling, his 10.5 principles. So my 5.5 ideas from Profit First. First, learn to live within your means. Oh, it's not popping up on there, is it? I can see it. Try it again. Maybe I'm not on the right screen. There it is. Learn to live within your means. That's the big idea. 30% is the target allocation percentage for a lot of us. Maybe it should be 35. But if you're spending more than 50, you're probably living outside of your means. You need to think about that. Next. It's not how much you make, it's how much you keep. He doesn't say this. This is something that I've heard and I like to tell my kids all the time. They say, you know, that so-and-so is so rich, right? They're driving a Ferrari or something. And there's a lot of Ferraris in my town. There's a lot of lawyers that love their Ferraris. And I question how rich they really are, because they hit these big paydays and they go out and spend all their money. You're not rich unless you can continue to live your lifestyle without continuing to feed it. So when you make money, how much do you keep of it? That's the big idea there. Destroy your debt. You need to pay down your debt, and then you can live freely. Think about, and so with that also, not only debt, but also eliminate your expenditures that you don't need. I am in a pretty nice room. You guys have seen my office here. It's actually $300 a month for the room that I'm in, and Tom's across the hall, and this is $525. So I think we have over 2,000 square feet of space in downtown Edwardsville above the best restaurant in the Metro East, and we pay $825 a month. I think that's pretty decent. A lot of people spend thousands and thousands of dollars. I'm not prepared to do that. And we're going to expand soon, and I think we're just going to expand down the hall. It's kind of what I've decided to do and not buy. Not at least anyway, not right away anyway. I think I'm going to start putting money into the profit account, and then perhaps someday I could put down a down payment and have that conversation. Next big idea is make sure you're cloning your best clients and fire your worst. It's not necessarily a topic I've talked about today, but he does go into how to increase your revenue, how to decrease your expenses. But I think this is a conversation we have over and over again. If you think about the 80-20 Pareto rule, 20% of your clients are giving you 80% of your revenue. So focus on those 20% of your clients, expand them, go to their conferences, think about how you can do more work with those people and their friends and their colleagues who are just like them. And finally, he says set up separate checking accounts. I like that. And with the key step 5.5 or idea 5.5 is put profits and taxes in another bank that make it difficult. So thanks for listening today. And I want to remind you that our next sessions next week will be Amanda Klein. We have another guest speaker. Thank you, Amanda. I don't think she's on today, but she has been with us before. She's going to be talking about email marketing. Now, I don't know if you guys receive it, but I receive hers. It's a really nice email marketing newsletters that I received from her, and she's just going to talk about how she did it, why she did it. And then in 2 weeks, we're going to have Ann Price. She's going to be talking about business planning. And then I have other ideas on what I want to put in there, but we're waiting to find out what the TIG wants to do, or if they want to do anything with this. We might start adding some of those programs in from the TIG for the sessions that were accepted, but were not exactly accepted for the virtual conference. A whole other conversation.